Amazon just released its Q2 2026 earnings. The stock jumped over 12% in after-hours trading, and in this video I'll explain exactly what happened. The numbers, why the market went crazy for AWS, how much they are spending on capex, and most importantly, whether after this rally it still makes sense to look at the stock or if the train has already left. The financial data and charts on the key performance indicators shown in this video come from justDCF, a platform that simplifies fundamental analysis and speeds up stock valuation. Link in the description if you want to try it. If you are into this kind of analysis, subscribe to the channel. Let's get started. Let's start with the big picture. Amazon closed Q2 2026 with total revenue $200 billion, up 20%. Operating income $27 billion, up 43%. That's crazy. One important detail, this operating income includes $1.2 billion in one-time benefits, about $600 million in tariff-related refunds, and another $600 million tied to the change in fair value of energy contracts for data center power supply. Even stripping out these one effects, margin growth remains very solid. Revenue was helped by the shift of Prime Day, which this year fell in the second quarter instead of the third. This also explains why Q3 guidance shows an apparent growth slowdown. It's not a negative signal, it's a poorly calendar accounting. And here we get to the highlight, the thing that really moved the stock, AWS. AWS revenue $42 billion, up 36%. This is the fifth consecutive acceleration in quarter-over-quarter growth, the fastest growth in the last 18 quarters, back when AWS had less than half its current revenue. The backlog reached roughly $500 billion, growing at a triple-digit rate year over year. On an annualized basis, AWS is now worth $169 billion in revenue. To put that in perspective, if it were a standalone company, it would rank 24th on the Fortune 500. That's crazy. Within AWS, there are two distinct engines feeding off each other, according to CEO Andy Jassy. Number one, the proprietary chip business, Trainium for AI, Graviton for general purpose computing, which has surpassed $25 billion in annualized revenue, growing at a triple-digit rate. Number two, the AI business, proper training inference agents, also above $25 billion, also growing at a triple-digit rate. A key point Jesse repeated several times, AI growth is pulling along AWS traditional core business too, because most post-training and agent tool use runs on GPUs, where Graviton, Amazon's proprietary chip, offers a 30 to 40% price performance advantage over alternatives. On margins, AWS operating margin rose 650 basis points, 520 basis points excluding the accounting effect from energy derivatives. CFO was clear this isn't random. It comes from operating efficiency, capacity optimization, and tight management of fixed costs. Here we get to the topic that divides investors the most, capex. Amazon raised its 2026 guidance from about $200 billion to about $220 billion, mainly due to rising memory costs. Jesse explained in detail the economic logic behind these investments, and this is the most useful part for understanding the stock's optionality. Number one, data centers have a useful life of 30 plus years, but require about 2 years of investment before they can start generating revenue. Number two, servers and networking, on the other hand, have a shorter cycle. They are purchased just a few months before being put into service, with real visibility into demand. Break-even arrives in about 3 years, while useful life is 5 to 6 years. So 2 to 3 years of pure free cash flow for each server generation. Number 3, each data center can host 5 to 6 generations of servers over its lifetime, and from the second generation onward the economics improve further because the upfront data center cost doesn't need to be repeated. So the practical consequence, in the short term this creates pressure on free cash flow, because so many data centers are being built in parallel before they can be monetized. But as capacity starts being utilized, according to Amazon, the returns become very compelling. Also worth noting, Amazon is reportedly considering selling Trainium chips to third-party data centers, not just using them internally, an additional source of optionality that the market may not be fully pricing in yet. The risk to watch: if AI demand were to slow down sooner than expected, all this capacity built in advance would become a drag on free cash flow for much longer than currently estimated. Jesse himself said that even at $220 billion in capex, capacity won't be enough to cover all of 2026 demand, probably not 2027 either, a sign of confidence but also of how big the bet is. It's worth looking at what's happening outside of AWS too, because the market often ignores it. So advertising, $19.8 billion, up 26%, growing more and more thanks to agentic purchases through Alexa Plus. Alexa Plus and Alexa for Shopping, over 350 million users in the past year, with active users nearly doubling in the quarter. Grocery, Amazon remains the second largest grocer in the US with over $150 billion in gross merchandise volume. And then we have Amazon Leo, the satellite project. Nearly 400 satellites in orbit, with commercial service expected to begin this year. Then we have the enterprise agents front. Amazon Q, the AI assistant for businesses, is now used by names like 3M, AstraZeneca, BMW, Exxon. Each of these pieces taken on its own would be a massive business at another company. At Amazon, they are oft rated as extras relative to AWS, which probably understates the group's overall value. So, is it still time to buy? First, a disclosure I owe you. At the time of recording this video, I hold Amazon shares in my portfolio. So keep that in mind as you listen to my opinion. Now, on valuation, one metric I like to use for Amazon is price to operating cash flow. Looking at this metric, Amazon today is trading close to its lowest valuation in the last 10 years. We are at around 18x versus a 10-year historical low of about 15x. Why do I look at price to operating cash flow instead of classic price to earnings or free cash flow? Because right now, Amazon is an extremely capital intensive business with enormous investments in AWS. This makes free cash flow a distorted measure in the short term, squeezed by capex, and it also distorts net income because as the ads business grows and AWS margins keep improving, net income will rise accordingly in the coming quarters too. Operating cash flow, on the other hand, better reflects the company's real ability to generate cash from the business, net of investments choices. For this reason, in my view, Amazon is still at an attractive valuation. Personally, I added to my position around $233 within the plan to buy more if it dropped into the $200 to $210 range. That didn't happen. The earnings were so strong that the stock is now railing hard. At these prices, I still think it's a good buy. But as always, this is not financial advice. Always do your own due diligence before making any investment decision. If you don't want to miss my real-time trades and my reasoning on stocks, I share everything in my investing club on Discord, link in the description. So that was the recap of Amazon's Q2 2026 earnings. Solid numbers, AWS accelerating hard, record capex, and several sources of optionality still underpriced by the market. If you find this analysis useful, hit like, subscribe to the channel, and let me know in the comments what you think. Would you still buy Amazon at these levels, or would you wait for a pullback? See you in the next video. Bye.